All right, so welcome everyone. Thanks for taking time to joining us in this session today. Today we're going to talk about and give a fresh look to what's happening in the markets, the economy, and more importantly, how we as long-term investors can navigate it with clarity and confidence. And there's been a lot of noise out there, as you know, headlines about debt, elections, tech bubbles, interest rates. But underneath that noise, there's also real opportunity. So let's take a disciplined look at where things stand at middle of 2025 and how we can stay focused on fundamentals, valuation, and long-term wealth creation. So here's a quick look of how different markets have performed in different sectors so far. So since the beginning of the year, the S&P 500, which is represented by the candle charts, is up at 1.88%. And this is as of this morning. NASDAQ is up 4.16%. Dow Jones Industrial is up 0.88%, but Russell 2000 is down by 3.44%. Russell 2000 is a small cap index. It's obviously been under pressure because it contains smaller companies and they are more sensitive to interest rates and they don't have some of the same financial flexibility and financial power as some of the larger companies. So here's some key takeaways. This so far is a narrow rally. There was a lot of discussion, remember, at the beginning of the year at how the markets are going to tank, how there's going to be a recession. So market has come right out of that. It's slightly up for the year, but again, it's still very fragile. It's not a reason to get too excited, but it's certainly a positive thing that's happening, that the market ultimately goes up. Even the negative sentiments that were happening, they really were things in transition because there was fundamental strength in the market, and I'll speak about that in a bit. So now let's take at which sectors are actually doing well this year, because this tells us a lot about where the capital is flowing into, and it shows where the strengths are at. So at the very top, you'll see basic materials. So since the beginning of this year, basic materials have performed and are currently sitting at about 10.22%. Utilities, 7.93%. Financial services, 7.82%. Communication services, 7.79%, and so forth. And technology, which was doing very well last year, hasn't done so well this year. So this year, it's only sitting at 2.68%. Energy, 2.24%. Real estate, just barely above 1%. Healthcare is down, and consumer cyclicals are down. And this sector map tells us a very different story than if we were to just look at the S&P 500 or the NASDAQ as we saw in the previous chart. It shows us the money is rotating into more traditional and defensive sectors. This often happens when the market is trying to adjust to higher rates or macro uncertainty. Even though these sectors, such as basic materials, utilities, and energy, have done really well. It just so happens that I actually don't invest in these sectors because these sectors are cyclical, they're capital intensive, and they're heavily influenced by external forces. So even though some of these sectors like basic material and utilities have done well, I actually look for durable businesses. So even though these sectors have done really well, I'm going to show you in the next slide how my personal stock portfolio has done. But ultimately, folks, what I do, and this is something I also talk about through my 5-minute test and the 10-year filter, is I look for businesses with durable competitive advantage, strong free cash flow, and high returns on invested capital. This is the kind of quality that can compound a business over decades, not just through spike cycles or up and down in certain cycles. So in fact, I've noticed that entering these sectors isn't actually about market timing. It's about sticking to a strategy which works in all kinds of environments. And that's what I do, and that's what I talk about with you guys. But I'm going to show you the proof in the pudding of how my own portfolio has done by following the strategies that I've been talking about with you all. So this is my portfolio since the beginning of the year. So the blue line represents my portfolio. The yellow line represents NASDAQ, and the green line represents the S&P 500. So you'll notice year-to-date S&P 500 has done 2.39%, NASDAQ 4.4%. My portfolio currently sitting at 10.59%. Right? And here's the interesting part. I didn't outperform because I chased sectors that were hot. In fact, if you look in the previous one, there were sectors such as utilities and basic materials that have done really well, and I have no investments in them. So why is it that my portfolio has been doing fairly well? The reason is because I have stuck to my process, which is only identifying and investing in high quality businesses, and I only buy them when they're trading below their intrinsic value. And as I was just speaking with Ramesh earlier before we started recording this, I also try to keep a margin of safety. So if the intrinsic value is supposed to be 100, I don't want to buy at 100. I want to buy at like 50, 60, 70. So whatever that number is, and there is a certain comfort level that I have. And based on the comfort level that you guys will create for yourself, which is unique to your own risk profile, you just stick with that. And that's what I've stuck with. And that's what things have done well for me. Last year, uh, as you know, I barely deployed my capital. Why? Because the companies that were on my watch list and my portfolio were overpriced. So instead of forcing trades, I waited. I stayed patient and I waited for the value. And that also connects with a conversation I recently had with someone in our Telegram group. He told me that he feels like he didn't have a plan. He felt like he was missing out. But here's the truth. This is someone who used to trade more frequently with his money and he used to lose money. But now he's doing research, he's building conviction. And what that leads to naturally is he's sitting on cash. And the deployment of cash comes when the opportunities meet your standards. So that's not called missing out. That's actually called growth. So last year when I was sitting on cash, I was actually not upset. I was like, it's okay. The market is going up. I'll just sit even because it doesn't meet my investment criteria. Remember, I've also said this many times. Investors like Warren Buffett, they have spent years trying to accumulate the allocation that they had planned for certain stocks. So who are we to not follow things like that? So I stick to my strategy and I wait. So here's some key reminders that I would like to share with you. And these are principles that keep coming back, especially during uncertain times. They become very important. Number one, never over concentrate in one stock or sector. It adds uncertainty and pressure and it adds volatility. Do not feel bad if you're holding cash. Remember, cash is equal to flexibility. So even Buffett, as I mentioned, he didn't buy Apple all at once. He moved and purchased them in stages. And above all, educate yourself. Know how to estimate the fair value of stocks. Understand what is diversification. Have a plan, not just a reaction. Don't be reactionary in the markets. If you're sitting on the sidelines right now, doing the work and waiting for the opportunity, you are, trust me, not behind. You are being intentional. And that's exactly what this style of investing is all about. Now, even though my portfolio has outperformed, it wasn't because I timed anything or I was chased out of hot sectors. It's because I stuck to my valuation framework and waited for quality businesses to become reasonably priced. But remember, back in April, just a couple months ago, the media wasn't exactly calm, right? There were headlines about predictions of crashes. That people were comparing what was going to happen to Black Monday, calling for financial reset. And you know what? Let's take a quick look at what people were saying back earlier this year and how things actually ended up turning out. So headlines were all full of warning. They were talking about Trump's tariffs. They were talking about potential Black Monday. They were talking about rock bottom markets. You name it, and everybody was talking. Jim Cramer on CNBC warned about a Black Monday crash in early April, and he compared it to the horrific 1987 crash. Dow Jones, S&P plunged back then 6% on a back-to-back days. At the same time, Robert Kiyosaki, who's the author of Rich Dad, Poor Dad, was predicting a major crash, even something as big as Great Depression scenario. And he was backing Bitcoin, gold, silver, all the way as safe havens. Now, look at what happened next. After the initial volatility that we obviously went through, the markets rallied very sharply. S&P recovered its losses by May 13th, and now it's in the positive territory for the year. That's 2025 in a nutshell. Big headlines, big scare, and what happens after that? The markets march higher. It isn't about dismissing risk, obviously, right? I'm not saying dismiss risk. And it's also not about ignoring real dangers. It's about recognizing how headlines can lure us into emotional investing. Later on, or very soon, I'm also going to talk about a slide that shows how sometimes these so-called institutional investors may start saying things that can start to influence markets. So for us as long-term investors, it means that we need to stay grounded in valuations. We need to stay grounded in identifying quality and sticking with a process, not with headlines. Okay? Now, what's been even more interesting, while retail investors, like people like you, me, were being bombarded with crash headlines, the big institutional investors, what were they doing? They weren't exactly leaning in either. In fact, their positions tells us that they were actually pulling back even as market climbed. And let me show you what happened. So this is honestly a wild one. This is also one of the images that I shared in our Telegram community. And honestly, one of my favorite charts right now. So according to Bank of America, there's something called a fund manager survey. So the institutional money managers were net 38% underweight on US equities in May. That's the lowest in 2 years. And what does that mean in simple English? It basically means that they were 38% underweight in the stock market. So in simple terms, this means that even though the market has been moving higher, big funds have not caught up. They're still playing defensive. Sorry, just a moment. I'm going to mute everybody. So as I mentioned, in simple terms, this means that even though the market has been moving higher, big funds have not caught up. They're still playing defensive. They're still sitting on the sidelines, maybe because of recession fears or policy uncertainty, essentially just a disbelief in the rally. But here's the key. If the market continues to climb, at some point, some of these funds are going to be forced to re-enter the market. And when they do that, they'll likely be buying back at higher prices. And what is that? That's a fuel for the stock market. And sometimes you're going to notice a ton of negative sentiment in the news. So remember, I was just talking about that you hear this negative sentiment. This is not always because people can fundamentally justify it, but it's because it can rattle investors and it can trigger them into selling their stocks and bringing the market right down just so the institutional investors can come back in. So remember, if they right now don't have equities, or 38% of them are underweight on equity, so which basically means they don't have stocks or they exited the stocks. Now, the stock market has gone up. So what do they want to do? They want the market to go down. So this is when you're going to start hearing some negative sentiment. When negative sentiment happens, retail investors will say, okay, I'll just sell the stocks because maybe the market is going to go down. But really what may be happening is that this could be intentional to bring the market down so that these institutional investors can enter. Now, this is not conspiracy theory. It's just market psychology, positioning, sentiment, and a flow of market just as much as fundamentals in the short run. But this is exactly why I stick to a process, right? I don't look at headlines. When institutional money is underweight and the market is still climbing, that often means that there is fuel left in the tank, especially if the market sentiment starts to shift. And why do I say fuel left in the tank? Because these investors with these billions of dollars are going to want to come back in, and the stock prices are high. When they buy it, guess what happens? Market goes further up. Here's a slide that shows something very interesting about market behavior right now. On the very left, right here, you're going to notice what retail investors have been doing. And who are retail investors? These are people like you and me. Retail investors, interestingly, bought nearly $40 billion in US equities in April. And what was happening in April? The market was down, right? So they came in and bought. This was the largest single month inflow that we have seen in years. So while the headlines were negative, individuals like you and me were quickly adding up. And I was also doing that. Now, on the right side, you have hedge funds, interestingly, that are doing completely the opposite, right? They have gone and increased their short positions by $25 billion in just a few weeks. This is the largest spike in short positioning on record in at least over a decade. So what happens in this case is when the markets go up while the funds are heavily short, right? What happens at this time is these funds are going to risk losses. And when those losses build up, they may need to close out those positions. And that process is where the short sellers are going to start to buy back stocks to cover their trades. This is known as short squeeze. So now let me be clear. We're not predicting, obviously, that there is going to be a squeeze, but the conditions are present, which is elevated short interest, rising prices, and a significant option expiration window that is coming up. So what is an option expiration window? Well, what happens is a lot of equities and index options, they have expirations. So options are, your call options and put options. So when you are short, you could be either selling a stock at a certain price and buying it at another price, or you could be buying puts. So all these options basically have an expiry. So there is a big expiry that's coming up, which is on the 17th of June. And because the market is closed on the 19th of June, which is called Juneteenth, 17th of June is when these options are going to expire. So traders and institutions may need to reposition themselves before that, especially if the prices continue to increase. So folks, I'm again going to say that it's not about making short-term calls. It's about understanding how positioning and market structure can influence short-term behavior. And for the long-term investors like you and me, it's a reminder that why staying grounded to the process of valuation and discipline matters, because that's what keeps you positioned for the long haul while something like this happens. And some of these institutional investors, like maybe they should start coming and listening to our webinars, because we go through the realities and we try to uncover what's under the different layers of the so-called onion of the stock market. So let's now take our focus to government policy and proposals and to rising debt levels and see how that might also be impacting. Because while all this is happening, which is market volatility, short positioning, institutional problems, the market is still climbing. But there is something bigger happening under the table, which is in Washington. These bigger conversations are going on, and that's what I want to talk to you guys about next. So, folks, what you're looking at here is a quick update on the One Big Beautiful Bill, which is also called the HR1. This bill was passed in the House on the 22nd of May, and now it's sitting in the Senate in the United States. Republicans are pushing, obviously, to get it signed by the 4th of July, but there has already been some resistance, especially around the Medicaid related provisions, and also Elon Musk has spoken against this. Now, I don't want to get political here, but as an investor, we need to understand how policy choices can impact fiscal health and how inflation and eventually interest rates can all start to impact the business fundamentals. The biggest concern isn't about this bill itself. It's actually what it represents, which is continued expansion of government spending at a time when the national debt is already significantly ballooned. So the real question becomes, how does the United States manage itself while the debt is growing? And what are its options to pay this debt? And what does that mean for common stock investors like you and me? So when we say national debt, we're really just talking about the total amount that the government has borrowed over time. So think about like a giant credit card where the credit card balance just keeps increasing, and the way we lower the balance is by collecting taxes. So as of now, that number stands at $36.2 trillion. Yes, that's trillion with a T. Now, that's obviously a big number, but the numbers only matter when we have something to compare them with. So what do we compare them to? We should compare them to GDP, which is the gross domestic product, which is the total output of the US economy in a year. And right now, the debt is, guess what? 122% of the GDP. That's high. And it obviously peaked during the COVID time, but US is still in a very elevated territory. And you know what? This debt level is actually growing very fast. And you know how fast? It's growing at $1 trillion every 3 months. I repeat, this debt has been growing at $1 trillion every 3 months. That's why there's so much focus on it, and especially on how it's going to be managed. Globally, the US is now in the top 10 countries when it comes to debt to GDP ratios. And I'm going to show you a comparison chart in the next slide, which is going to show how other countries rank up. So while it's not a crisis today in the United States, it's certainly a structural issue that needs some attention. And as investors, we need to understand what this means to interest rates and economic flexibility. Remember, interest rates become very, very important, obviously, to us as consumers, but as investors in the stock market, to small and mid-cap companies that depend heavily on borrowing money and loans, if the interest rates remain very high, well, obviously their output starts to get impacted. When we talk about what the government is currently doing, which is taking on or increasing debts, that certainly starts to have an effect on the kind of stocks that we invest and what their performance is going to be like. Because if these companies make profits, that increases their fair market value, and their stock value will ultimately, at least in theory, climb and grow to that level. Now, other thing is, you must have also heard of something called the debt ceiling. So Congress reinstated a debt ceiling on the 2nd of January this year at the level of $36.1 trillion, which was basically just the same level of the debt which was at that moment. But the US ultimately ended up hitting that debt limit right away. And since then, the Treasury has been using what they call extraordinary measures just to keep the lights on. So what do these extraordinary measures mean? It means that government is going to delay certain kinds of investments and moving money around more internally, more like temporary stuff. But both these measures are expected to run out in August or September this year. And at that point, what's Congress going to do? Well, they are going to want to raise the ceiling, or maybe there's going to be a default. We don't really know what's going to happen, but we'll cross that bridge when we get there. So first question that should come to your mind at this time, because I've spoken about the US debt and I'm soon going to speak about deficit, is, hey, Amit, what is the difference between these two? So federal deficit is the shortfall. It basically is how much money the government spends in a single year compared to the amount it collects in revenue, and that mostly comes through taxes. So if the government brings in more than it spends, that's called a surplus. But that happens to be rare, as you can see in the chart, which I'm going to talk about momentarily. And if the government, on the other hand, spends more than it brings in, that's called a deficit. The US national debt, on the other hand, is a total amount of money the government owes from all the past deficits minus any surpluses they may have had. So it's ultimately cumulative results of running deficits year after year. That is the one that has ballooned significantly. So what you got to think of it is like this. Deficit is this year's gap, and debt is the sum of all past gaps. Now that we've covered the national debt and the total, let's zoom in on the federal deficit, which is what adds to the debt each year. So looking at this chart on the left side, you're going to notice that back in early 1960s, the US government actually ran a surplus. Now, it wasn't a big surplus. It was only 0.06% of the GDP. Then we went through the 1970s and 80s, and guess what? This deficit started to grow. But here's the thing. In late 90s and early 2000s, under President Clinton, the US actually ran a federal surplus of 2.3% of GDP. And that was driven by strong economic growth and a booming tech sector and higher tax revenues. But fast forward to 2020, COVID time and whatnot, right? During COVID, the government started spending aggressively to support the economy, while the tax revenues dropped due to widespread job losses. People were staying at home. There was not money being spent in the economy. What ended up happening? Record-breaking deficit, and that went all the way to nearly 14.67% of the GDP. And this was the deepest it has ever been. Since then, the deficit has started to reduce during the time of President Biden. And it ended up going up to like here, like now it's currently sitting at 6.28%. The deficit has gone down, but it's still pretty high. I'm going to talk about later on how these deficits are going to be reduced. And we're also going to make sense of what President Trump is trying to do. But on the right side, this is a chart that I mentioned earlier, shows us how different countries rank up when it comes to their total debt to GDP ratio. So Sudan is at 252% and the United States is 123%. And for my Canadian friends, our debt to GDP ratio is actually less. We're at 113%. And how does India sound? India is at 80% and so on and so forth. So you can pause this chart and have a look at the countries of interest and how they rank according to this. Now let's talk about the big elephant in the room, and that is the $36 trillion in US government deficit. Now, to give you some context, the entire US economy, the GDP is only at 28.7 trillion as of this year. This means that the total debt that the US has accumulated is 125% of its full GDP. So debt is 36 trillion and GDP is 28, and debt to GDP ratio 125%. And this is a level that is the highest we've seen since World War II. And yet, this isn't something that you hear a lot about in the mainstream media, because this is not a quick fix problem. This happens to be a structural problem. And this is not a question if this is going to be addressed. The question actually is how those costs will be distributed across the economy. So let's take a look at three strategies that the governments have historically used to manage large debts. So strategy one is to grow the economy faster than the debt. This is the ideal strategy, which is borrow money to invest in productivity like infrastructure, defense, artificial intelligence, and education, and collect more in tax revenue over time. And yes, this can work, but economic growth is not guaranteed. And interest costs keep rising in the meantime. So it's like borrowing to build a business, and if it works, it'll give you the returns to exceed the borrowing costs. That's strategy one, which is grow the economy faster than the debt. The second strategy is let inflation do the work. And this is a very subtle kind of a strategy, but it's a very powerful strategy. So if the government borrows at a fixed rate and inflation rises, it erodes the real value of the money that it actually owes. So while this helps ease the debt in real terms, it also impacts savers like you and me, because the prices go up through inflation and the money that we have buys less. That's why protecting the purchasing power becomes the key focus for long-term investors. Strategy number three, and this is an option that tends to be less popular, obviously, but historically, governments have reduced deficits through some combination of higher taxes or lower spending. And this could mean reduced funding for federal programs or increased taxes. Now, both of which carry trade-offs. So what does this ultimately mean for investors like you and me? You see, the point here is not fear. What I want to do is I want to increase awareness of debt, inflation, and taxation. These are long-term structural forces, and they affect how far dollar actually ends up stretching and how your investments behave over time. Obviously, that's exactly why financial education is important, because managing money isn't just about growing your portfolio. It's also about protecting your future buying power. And that's the work that we have been doing here on this channel, which is a YouTube channel, our webinars, our Telegram community. If you haven't already joined our Telegram community, I highly recommend that you join it. because that's where we go deeper, from understanding macro signals to evaluating business fundamentals using, our 5-minute test and the 10-year filter that I have created and whose videos I've also created for you. So if you haven't watched, please watch those. Now, whether it's a question on diversification, a question on exit strategies, or spotting overvalued stock, our members in our Telegram community have been asking these, and I do my level best to answer those questions. And you know what? As you know, it's completely free. It's where independent, global minded investors like you and me exchange ideas and we talk. So now I want to start going into each of these strategies because this is where things become very interesting. So, first strategy is grow your way out of debt. The basic idea behind this is borrow more now to stimulate growth and let bigger economy take care tomorrow to make today's debt feel smaller. And that's exactly the logic behind the proposal of what President Donald Trump has come up with, which is called the One Beautiful Bill. It aims to pump $2.6 trillion into the economy through tax cuts and spending over the next decade. Yes, I totally get it that this is going to increase the deficit in the short term, but the goal of this kind of a strategy is to create enough economic growth and the debt that you take on becomes more manageable over time. So, how is this supposed to work? Let me show you. So number one is, first, the bill proposes what's called a consumer tax relief. So especially changes to what they call SALT deductions. So these are deductions to the state and local taxes. Right now, people in the high tax states like New York, California, they're capped at $10,000 in deductions. Lifting or eliminating this cap is immediately going to give these households more take-home income. And what happens when you have more take-home income? Well, these households will start to have more cash. They'll start to spend more money or save more money or invest more money. All of that helps fuel the economy. The second thing it's going to do, or this bill proposes, is to offer businesses incentives like accelerated depreciation, research and development credits, and possibly lower corporate taxes. This basically is meant to encourage businesses to reinvest, buy equipment, hire workers, build for the future. And this kind of reinvestment creates jobs and lifts productivity, which helps the GDP. Now, accelerated depreciation that I talked about. So when a business purchases something, it goes into their balance sheet as an asset, but every year they can start to throw part of that as an expense, which starts to reduce the amount of taxes they owe. So when President Trump had come earlier, there was something called an accelerated depreciation. So businesses were actually able to throw a huge chunk of their newly acquired assets as depreciation. So this bill is going to start increasing that because it was supposed to taper off after the first term of President Donald Trump. The third thing this bill is going to do is it could include tariffs, which obviously is a very protectionist strategy aimed at boosting US manufacturing. And by making imported goods more expensive, tariffs can be redirected to domestic producers. What is that going to do? It's going to help local factories produce local jobs and industrial investment in the short term. And you know what? None of this is new. We have seen similar playbooks take place in 2008 financial crisis, which was, at that time, there was a 787 billion bill, which was called the Recovery Act, and it included tax reliefs, infrastructure spending, and bailouts to try to reignite the economy. And even going back all the way to Great Depression, during President Roosevelt had something called a New Deal, which was built on the exact same principles. It was basically to invest heavily in infrastructure, employment, and essentially kickstart the economy. And you know what? I remember this so well because when I was in my grad school at Cornell, during the 2008 crisis, we were studying macroeconomics while watching all those theories act out in real life. Every day, we would watch headlines about stimuluses and federal moves and the government interventions. It was absolutely surreal because it was essentially textbooks coming back to life. And I see the whole thing happening all over again. That experience at that time taught me something very important, which is that stimulus can actually work, but only if it is done in a productive fashion. If the money goes towards infrastructure, education, and innovation, that ends up creating long-term value. That ends up being at the heart of what's called Keynesian theories. And that's the photo of a person I put here. If any of you have taken macroeconomics, you're going to study a lot about this guy. So Keynesian theories basically say that at the time of depression or economic slowdown, when private businesses pull back and consumers stop spending, governments should actually step in. What should they be doing? They should be spending more, investing in public works, and cutting taxes, whatever it takes to get the money flowing back in again. Keynes believed that the demand drives economic growth, and if the demand dries up, then usually government has to come in and fill that gap. Now, this was a major shift back then from older theories that said the market always fixes itself. This came in during the Great Depression time, by the way. And Keynes said that sometimes markets do not fix themselves, or at least not fast enough. So, Keynesian thinking is basically that in the downturn, use government spending to restart the engine. And once the economy is growing up again, then the governments can pull back and let the private sector kick in. That's why stimulus policies, like the ones that we saw in 2008 or during COVID, they're called Keynesian tools. They aim to stabilize the economy by increasing short term demand, and they hope to create long term growth with that. The same thing is happening in Canada as well. But again, the key is whether the spending is productive. That's where the theories work. But where the theory does not work is if the execution is poor. So, for example, if the debt that the governments take on is instead used to buy votes, fund inefficiencies, or inflate short term numbers, then it's just debt without a productivity multiplier. And there is an example of that happening in the world right now, and that country is Pakistan. In Pakistan, this country's external debt has crossed $130 billion. Its debt to GDP ratio is over 75%. Obviously, it's less than the United States, but that country is not as productive as the United States. Instead of investing that money in the future, such as schools, high-tech companies, or its healthcare, the largest budgetary increase happens to be in the defense spending by about 20% while cutting development funds. Now, debt servicing costs are larger than their entire tax exemption pool. So that's what happens when the debt is not productive. You get low growth, high inflation, and the middle class that is kept in a losing ground. So yes, grow your way out of debt, which is the first strategy that I just talked about, can work, but its execution is everything. Without discipline and long-term thinking, it's just kicking the can down the road. So if you hear those in the United States, if you hear your government doing this, then if you want to ask questions, make sure your questions are around what are we actually doing with that money? Are we actually putting in the right places? And are there key performance indicators that are showing results? So remember, we don't build our portfolios based on policy forecasts. So even though this is happening, we don't build our portfolios based on that. What we do is we, again, focus on business fundamentals, on valuations, and owning companies that can drive through multiple cycles, not just during the stimulus cycles. So remember when downturns happen, bad companies end up losing a lot of money. So again, that's where valuation comes in because long-term resilience beats short-term hype. Now, let me bring you to second strategy. The second strategy is a little more nuanced, but it's extremely important for us investors to understand. The idea behind the second strategy is that debt can actually be cheap, especially when inflation is high. Now, I know that this might sound strange, especially since we keep hearing about interest rates increasing, but let's break it down. You're probably familiar with the term nominal interest rates, right? So nominal interest rate is typically what is advertised interest rate. So such as the 4 to 5% what the treasury bonds may give, that's called the nominal interest rate. Because inflation eats away the value of the money, the real cost of debt isn't just the nominal interest rate, which is 4 to 5%. It's actually what the rate feels after accounting for inflation. And that's what brings us to the real interest rate. So let's say the nominal interest rate is 4% and the inflation rate is 3%. So the real interest rate is actually 4 minus 3%, which is 1%. And if the nominal interest rate is 5%, and the inflation is 3%, guess what? The real interest rate that the country will end up paying because the value of the money goes down is a lot less. So 5 minus 3 is just 2%. So even though it looks like the government may be paying 4 to 5% in interest rate in actual burden, when you adjust that for inflation, the money that the government is actually going to pay is a lot less, just 1 to 2%. So if this inflation stays elevated, the government can repay its debt in dollars that are worth a lot less than the dollars it actually ended up borrowing in. So imagine borrowing $100 today and you pay back that money in 10 years. If the inflation stays at 3%, those $100 are only going to buy you what $70 buy you today. That numeric value has not changed. It's still $100, but the real cost has dropped. That's what the economists meant when they talk about that the government inflating away part of their debt. I also want to give you a historical perspective. This is absolutely not a new tactic. After World War II, the United States debt level was extremely high. But instead of defaulting or slashing spendings overnight, the government let a mix of strong economic growth and moderate inflation reduce the debt to GDP ratio over time. And that's exactly what I think the policymakers in the United States are hoping to happen again. Even in Canada, they're doing probably the same thing, which is sustain modest inflation, fuel the growth, and let time do the heavy lifting. But here's the catch. Inflation doesn't just reduce debt, it actually erodes away the value of our own savings as well. That's why, as investors, I keep telling you guys, it's crucial that we don't just sit on cash or low yield bonds. We need to be very productive with our money. We need well valued businesses that have pricing power. So, companies that can actually pass the rise in inflation onto their customers and continue to grow. And that's where financial literacy gives you that edge. Because if you understand the difference between real and nominal interest rates, you're already starting to think like a serious investor. Now, I'm going to bring you to what's called unpopular strategies. Okay, so popular strategies I just discussed. Now, here's some unpopular strategies which a country can use to also grow the economy, get over the high debt amount. So, what are these? These are doing spending cuts, and second is increasing taxes. Let me talk about these. So, at a first glance, spending cuts seems very logical, right? If the problem is we're spending too much, well, spend less. But in practice, this is not that simple. More than half of the federal budget happens to go to Social Security programs, Medicare, and these are essential programs that millions of Americans rely on. In Canada, we have very similar things. We have the medical system, education, and Social Security. So cutting funding into these kinds of programs is very, very unpopular. And you know what? It can be very, very dangerous as well for those politicians. And then we have defense spending, which is often considered off limits. And clearly interest payments as well. So countries like Canada, US, we have such high debts, the interest payments obviously have to be paid and they cannot be skipped. So even though people often talk about wasteful government spending, when you look at the numbers, there just isn't a lot of room to make meaningful cuts without affecting essential or protected programs. And if a politician comes and says, oh, I'm going to cut down on the number of people that are working in the government, that also is not good. And in Canada, we could see that did not lead to a very good political result. Now, what about increasing tax? That's a second strategy. So a country can increase their revenue by increasing the taxes. But again, this is also a very politically difficult thing to accomplish. Nobody wants to be the one to say that, hey, your paychecks are going to shrink or your business will owe more. And even when taxes increases are proposed, the debate becomes who's going to pay first? Should it be corporation? Should it be high earners? Should it be general population? You see, each option comes with backlash. And the concern about slowing down growth, reducing investments, or hurting consumer spending is always there. So if you increase taxes on, let's say, the high earners, well, guess what they're going to do? They're going to reduce the number of people they hire, or they're going to reduce the number of investments. That happened to one of the political parties in Canada. They completely got wiped. So these are unpopular strategies. So instead of making these tough calls like deeply cutting spending or significantly raising taxes, both political parties in the US, so let's say the Democrats and Republicans, they default to what is easier, and that is more stimulus, more spending, and hoping that growth is going to take care of the rest. So folks, I wanted to talk about this because, when you hear about the kind of decisions the policymakers are doing, like President Donald Trump is coming out with this beautiful bill, he's not an inexperienced person. In essence, I would say he's a very shrewd businessman. He knows what's happening. And also, he has a lot of smart people giving him the advices, which are translating into his action. So for us to simply go and say, oh, what they're doing is absolutely berserk, I wanted to come in today and show you the realities and the reasons why these kinds of decisions are taken and how these decisions are actually maybe gauged or they're disguised as looking something new, but fundamentally, these are not new strategies. These are tried and tested strategies that have worked in the past. Just their numbers are different and some styles are different, but ultimately, they're the same things. Hope that gave you some knowledge today. And thank you, everybody, for watching this video. But for those who are watching the webinar, I open it up to your questions now.